Hello, welcome back to Ruben Tech, where we discuss everything. And today we're going to be talking about wheel strategies, and I'm going to be using my friend Gemini Advanced, specifically the 2.0 Flash experimental version, which Google released a few weeks ago to help explain it. Now, first of all, neither I or Gemini are financial advisors, so make sure you consult a financial advisor before doing anything with your money. Now, that said, let's go ahead and get into it. First things first, let's ask Gemini what it thinks a wheel strategy with options is. Hello, Gemini. What do you think a wheel strategy with options is?
The wheel strategy is a way for options traders to make money on stocks without having to actually buy them outright. It involves selling something called put options and covered calls. The goal is to collect a steady income from these sales. Would you like me to explain how selling put options and covered calls works? Oh, also, just so you're aware, I'm not a financial advisor, so please don't rely on me for financial advice.
So what did you think? I thought that was an absolutely amazing answer. Typically, AIs will give you a super long-winded answer. That was perfect. I mean, I'm actually really shocked at that. Let's go ahead and ask what it thinks selling a put option is. Now, just so you know, I have videos on this, but I want to see if Gemini can keep answering this in a very short manner like this. That's just really on point. Actually, could you explain selling a put option to me very shortly?
Sure thing. When you sell a put option, you're basically making a bet that a certain stock's price won't go down below a certain level called the strike price by a certain date. If you're right, you get to keep the money you got for selling the option, which is called the premium. But if you're wrong, you could end up having to buy the stock at the strike price, even if it's lower than the market price at that time.
Okay, well, that was actually a pretty nice answer by Gemini also. So typically, when you enter into a wheel strategy, you're going to sell a cash secured put. I think it's the least risky way to do it. You're going to look at a stock and say, where am I comfortable holding the stock at? What can I collect for premium if I want to initiate a position? And that's where you sell your put at. And then if that gets executed, you initiate the second part of the wheel strategy, which is you sell a covered call, typically above what you paid for the stock. Okay. And so then you have that covered call. And if that gets executed, what do? You wheel strategy. You go back to the other side. You just flip. Okay. Well, now I sold a covered call at this. I'm going to look at where I'm comfortable holding a stock, or maybe I'm just going to look at, this price just below where I sold it. I'm going to sell a put option there. I'm going to collect a premium on that. Okay. And so the way it ends up working with the wheel strategy is typically you're looking for the stock. If you just want to sit back and collect premium, you're looking for the stock to stay within a certain band. Okay. And as long as it's within that band, you're just going to collect premium back and forth. And in fact, the best way to exit, the perfect scenario when you're executing a wheel strategy, I would think the perfect scenario, okay, is if it just stays right in the middle of that band somehow by the expiration date, but still has volatility where you're getting paid good premium. So maybe in between the days is fluctuating, but whenever the expiration date comes, it goes back to exactly where you want it. Now that would be an impossible thing, but it's kind of that notion. So let's go and look at a wheel strategy I've just opened up that I plan on executing with NVIDIA. I took a little bit of a riskier stance in this because I opened it by buying shares. So I bought 200 shares of NVIDIA. I'm selling a covered call, which means I have to have the position. I sold 2 contracts. Each contract represents 100 shares, 200 shares of NVIDIA right here. Okay, bought these at 139. Come on. It's supposed to pop up a little thing that shows you. Well, I know what I bought them at, but I can't stand. Okay, Charles Schwab. I just can't stand it. There it popped up, the little overlay, the UI. Once Robinhood offers another deal, like a bonus to move over, I'm going to just close this account. 139.49. It's almost as bad as Vanguard, but Vanguard isn't meant for daily trading. It's just something that you put your money in and it sits there forever in VU funds or something like that. 139.49. Okay, so that's where I bought this. So what did I do? I sell a cover call, this initiate my wheel strategy at 144. Okay, so my best case scenario here is that NVIDIA, well, I mean, there's 2 best case scenarios. You could say 140, if NVIDIA goes to 144.01, that might be my best case scenario because when I sold this covered call, I got paid $5.85 a share, sold 2 of them, 200 shares. So I collect this premium right up front. So this is in my pocket. This is mine. Okay. So if it goes to 144.01 by 124.25 on that expiration date, I'm going to get liquidated of these shares and I'm going to sell them at 144.01, which is essentially 144. So I'm going to get $28,800, but it only costed me $27,898, right? See that? So I'm going to collect an additional $900 on top of this, bringing my earnings to $2,000 on this leg of the will strategy. And then I will go ahead and I will sell a cash secured put because I have the cash now, and I'm going to execute the second part of the will strategy, and I will sell it within my band at probably, if it went up to 144, I actually did it, I'd probably sell it again at 139.50, or I'd sell it at 140. Okay, depends if they let me sell it in 50-cent increments, maybe not, but if they, probably 140 is what I would sell it at. Okay. And so now I'm going to collect a premium on that. I will tell you the premium is not going to be this big. There's more volatility on selling covered calls than there is on cash secure puts. So you're not going to collect that. But I'm going to keep selling that. And if it drops below that, it will execute. I will buy 200 shares of NVIDIA at, the 140 strike price. And then I'm going to go ahead and I'm going to sell another covered call. And I'm going to make sure that it's above 140. Now, I just keep going back and forth. I keep collecting this premium. I'm in a perfect world, right? What can break my perfect world? Volatility can break my perfect world. If on this, let's just say this position right here, I've collected $1,170. But what if NVIDIA went down to $100? Well, I would lose roughly just under $8,000. Now, it wouldn't be realized losses because I'd be hanging on to this, but that's where I said you must be comfortable holding the stock. Okay, you must be comfortable holding it. But now I have a difficult strategy because now I'm sitting here and as part of my covered call, I should sell another covered call, but I'm not going to get, if it drops down that much, trying to sell above my strike price, I'm not going to collect any premium. Right? So I'm going to have to adjust my premium to a point where it's almost like I don't want it to get called. I want to collect premium, right? But it's down so far in my position, it's going to be hard to make up that loss in premium. Because if it does make so like for instance, to collect any kind of significant premium, like here you can see I made $5.85 a share, right? That's 1 month from now. For at the time $5.50 above the price. But if it drops down to 100, well then, right, I'll only be collecting $5.50 a share on 100. It'll be 105, right? And I'll still be down significantly on my shares, right? I'll be down like $6,800. And imagine that it goes above that 105. Now I just close my position and I'm taking a real loss. So do you see the issue there? That's what breaks it. Volatility breaks it. But you don't have to, obviously. But for me, I prefer a little volatility because this is how you get paid. If I'm going and I'm looking at Apple's not as volatile as NVIDIA. Their premiums don't pay as much, okay? Or if you were to go and look at Tesla, those premiums are absolutely insane, but Tesla's movement is insane. So you just never know where you're going to be. Okay, so that's essentially the wheel strategy. The risk with it, of course, with anything in the stock market is volatility. The ideal situation is you set up this band of prices that you're comfortable with and that you can adjust. Technically, the best situation would be is if you slowly adjust it up. And what I mean by that is imagine I bought this at 139.50, right? Buy in 144. Again, imagine this. It sells at 144.50. It doesn't matter. I lose a little bit of opportunity cost there. It doesn't really matter. I collect $2,000, right? So now I sell a cash secured put at 140. Okay. And so now I collect the premium on that, and imagine that it goes down to 139.50. lose a little bit on the shares. Again, not realized loss, but I collected my whole premium. Okay. Now I have the shares and I gently move this up 145, right? Now it goes up to 145. I catch 145.01. I catch that upside. I collect my whole premium. And so I'm gently moving up with it. I keep collecting premium. And at the same time, I'm also catching upside on the stock without realizing any of the negative because it's staying within my band. That would be that's like a lottery scenario. It'll never happen. But we try to get as close to that as possible. So anyways, hopefully this explains the wheel strategy to you. To all of you out there, have a very Merry Christmas. I hope that your holidays are safe and all of that. So if you haven't already, please hit like and subscribe. Thank you.